Hello everyone, welcome to our channel Intelligent Investor. In this video, we are going to discuss about earning per share, price to earning ratio and price to earning to growth ratio, that is EPS, PE ratio and PEG or PEG ratio. First, earnings per share. EPS is a measure of company's profit per share. Earnings per share is calculated as net profit divided by number of outstanding shares. In case company pays dividend, then the dividend paid is subtracted from net profit and then divided by number of outstanding shares. Let us take an example: stock A and stock B. Stock A and stock B are in same sector and you are going to invest in one company, but you get confused. Stock A's profit is 10 lakh and it paid dividend as 2 lakh and total number of outstanding shares is 1 lakh. Then earnings per share is 8 rupees. On other hand, stock B, its profit is 20 lakh and it paid dividend as 4 lakh and total number of outstanding shares is 4 lakh. Then earnings per share is 4 rupees. From this example, stock A earns 8 rupees per share, which is more than stock B earns 4 rupees per share. This shows stock A is better than stock B. But remind that earnings per share is not enough for a company to invest, but earnings per share is also helps to choose better growth company. Second one is price to earnings ratio. PE ratio is calculated as price per share divided by earnings per share. PE ratio is used to determine how much investors are willing to pay for a stock related to its company's earning. For example, again take stock A and stock B. Stock A current traded price is 100 and its EPS is 5 rupees. Then PE ratio is 20. On the other hand, stock B common traded price of stock is 150 and its earning per share is 10 rupees. Then its price to earning ratio is 15. In stock A, you have to pay 20 rupees for earning of 1 rupee, but in stock B, you have to pay 15 rupees only for earning of 1 rupee. From this example, stock B performs well. Stock with high PE ratio are considered to be overvalued. Third one is price earning to growth ratio or PEG ratio. Price earning to growth ratio is calculated as PE ratio divided by earnings per share growth rate. PEG ratio is used to determine a stock's value while taking the company's earnings growth into account and is considered a more complete picture than PE ratio. For example, again take stock A and stock B. Stock A's common trading price is 100 and its earning per share in 2018 is 5 and estimated earning per share in 2019 is 7.5. Then PE ratio is 20 and growth rate of earning per share is 50%. Then PEG ratio is 0.40. For stock B, common traded price is 150 and its EPS in 2018 is 10 rupees and estimated EPS in 2019 is 12 rupees. Then PE ratio is 15 and growth rate of EPS is 20%. Then PEG ratio is 0.75. In PEG ratio, the lower value is considered to be a good investment. Based on example, stock A has highest PE ratio at 20 and it looks expensive. On other hand, stock B, which has low PE at 15 and it looks cheaper. But there is one major difference between these two companies, which is that stock A is growing its earning per share at much faster rate than stock B. This example given how quickly stock A is growing, and when we do this, we see that stock A may actually be cheaper than stock B. There is some disadvantages in PEG ratio, that is, if company pays dividend, the growth rate will decrease and it increases PEG ratio. Another limitation is estimated growth rate, that is, it is difficult to predict future events. On next video, we have to discuss remaining ratios. Subscribe for more. Thank you.